Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions featuring the proprietary bull-bear point and figure market breadth summary chart for November 25th, 2018. Market breadth. With this past week's market decline, our bull-bear point and figure ratio at 0.42 fell from 0.51 last week. The total count of securities in bullish or bearish patterns increased fractionally to 2,752. The count of bearish stocks increased 7%, while the count of stocks in bullish patterns decreased 11%. The Pirls PNF market breadth summary chart shows us a market now 11 weeks in bearish territory. Paid subscribers have access to the open office calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 30 points for the 8th decline in 12 weeks. At a negative 749.49 points, it continues below all 8 tops above plus 100 in the last 30 months, and it continues below 4 of the 5 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 0 accumulation days and 2 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode, on higher average daily volume. Momentum. The CCI 20 daily is now at a negative 134.32, down from a negative 44.78 last week. At Monday 11/19 close, the CCI 20 daily formed a zero-line reject pivot short entry signal, pivoting inside the plus or minus 50 range required for a valid zero-line reject entry signal. We plan to exit the trade simulation when the CCI 20 daily rises above minus 100. In Woody's CCI trading system, 6 consecutive bars above or below 0 are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's downtrend a week ago, while the daily CCI 20 began a Woody's uptrend this past week. The CCI 20 weekly, in a Woody's downtrend, fell to a negative 173.93 from a negative 144.72 last week. It continues outside the plus or minus 50 range required for a valid zero-line reject short entry signal. Industry rotation, the last 2 weeks. Only 2 of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: REITs and gold and silver on the top. Oil services, retail, and some tech on the bottom. Bullish: oil services continues in the bottom 5. REITs continues in the top 5. Computer hardware has left the bottom 5. Bearish: gold and silver has entered the top 5. S&P Retail and Comp Tech have entered the bottom 5. Oil has left the bottom 5. KBW Bank has left the top 5. Focus this week from www.northmantrader.com. Weekly Market Brief. Bear Trap by Sven Henrik. The following are some key points and charts. Are markets setting up for a major bear trap? Let's explore the question. Look, I could show you 100 charts that say the same thing that everybody already knows. Things are terrible. From crude crashing 7 weeks in a row, FANG dropping $1 trillion in market cap, and individual stocks being taken out back and shot. Crypto is a wasteland. Global growth is continuing to slow down hard. Germany just printed its lowest GDP growth in nearly 4 years. And U.S. growth is heading back to a 2% regime. Bulls that were aggressively pushing for ever higher targets are sheepishly reducing them fast. One analyst dropped his 3,200 year-end target on SPX to 2,900. Another dropped his 2018 Bitcoin target from $25,000 to $15,000. It's trading at $3,700 this weekend. And downgrades are permeating the daily news cycle. Long gone is the talk of global synchronized growth that dominated the headlines earlier in the year. Currently, the year is shaping up to be the worst ever in terms of total asset classes in negative territory, 90%. In short, bears have taken over everything and are dancing on the corpses of bulls that have mocked them for so long. Last week's price action was the most miserable Thanksgiving week in recent memory. In lieu of that, I have a question. Why haven't we taken out the lows? I mean, given all this backdrop of global misery and wipeouts in asset classes, why is the SPX still in range? Indeed, at this very moment, that chart says higher lows. Now, of course, that can change in a hurry next week, and we may enter that next risk zone we've been discussing. But why haven't we seen new lows yet? What else do bears need? I tell you what they need. A failure for the U.S. and China to come to a trade war resolution, the Fed to remain hawkish into 2019, the Brexit deal to fail in the UK Parliament. It was just approved by the EU. And the ECB to follow through on ending QE. We agree to are the 3 magic words that would cause a buying bonanza if they are uttered in some form during the G20 meeting between President Xi and President Trump next weekend. In the larger geopolitical and macro context I outlined above, this chart may be the most important chart on the planet right now. Here it is, the global Dow Jones, an index that tracks 95% of global markets. It's an incredible chart, actually. You can see how precise the price action has tracked the 2 rising wedges. In 2007, the global bull market ended when the wedge was broken to the downside. Since the 2009 lows, a new, larger wedge has formed, and it's just as precise. And now we're back to the lower trend line. So where's the bear trap? The bear trap would be a failure by bears to create a sustained break of the trend line. Get some or all of those triggers I mentioned above resolved, and one can imagine all kinds of rally scenarios. What about the carnage in tech? Check this out. Here's the NASDAQ monthly futures chart. It has not broken its 2009 trend line, and even if it were to, on a spike down basis, note the rather pronounced support line that is lurking just underneath. The NASDAQ, its internals, are also showing a massive positive divergence as NDX is renting a potential bullish wedge. Very clean, all this. Just saying. Bears, watch out. NDX MACD histogram is more oversold than even during 2009. It's now at levels not seen since 2000. And even then, those type of readings ended up producing massive counter rallies. Crude has also entered a zone of key support from which a sizable rally could emerge. Bottom line, from my perch, there is a solid case to be made for a bear trap in the works. The technicals are lining up for it, but it also requires the positive resolution of some macro triggers in the days ahead. Brexit, Fed, ECB, and trade war. I can't predict what the G20 meeting between the US and China will produce, other than a major gap event in either direction on Monday, December 3rd. I will suggest, however, that both sides have a vested interest in markets not collapsing further into December. Bears, as successful as they have been, have so far failed to produce new lows, and perhaps that should be a reason for them to not get too cocky at this precise moment in time, especially considering one additional factor. Bonds have so far averted the feared breakdown, and the yield scare has for now disappeared from the headlines. And maybe, just maybe, the bond market is signaling something other than an economic slowdown. Perhaps it is signaling a dovish rate hike to come. Bear trap? If it is to be, the technicals show signs for its potential. Thank you for watching this week's Santu Pirls Stock Market Commentary video featuring the proprietary bull-bear point and figure market breadth summary chart compiled by Donald Pearl, www.s2pmarketsignal.com. For Santu Pirls Stock Market Commentary, I'm Cynthia Pearl, hoping that you have been enjoying a peaceful and pleasant holiday weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.